So we are going to be looking at risk and uncertainty. So what do you mean by risk and uncertainty? What are the methods of mitigating risk and uncertainty? Then, of course, we are going to have illustrations after that. Let's see where we are going to stop or end the class today. All right. Um, I think I can use this learning material to do the explanation. All right. So she make it faster then. All right. Um, let me see. So when you talk about risk and uncertainty, every individual, including businesses, um, undertake some level of risk in their daily activities. All right. Because not everything is certain. Not everything or any of our conduct is certain. Therefore, there will be an element of risk and also uncertainty in some of the things that we do. We are looking at the perspective of business in this case. So businesses operate in an environment that involves the element of risk and uncertainty. This is because the cash flow estimates, the budget plan, the projection, the financial projection may be different from the expected results. All right, due to prevailing market condition or some external variables that may limit the ability of the company to take advantage of market condition. For example, inflation can impair or can reduce or impact the value of the cash flow of a project, right? A company may, for example, make projection that because based on what we did last year in 2024, for example, that a company makes sales of 100 million naira. So as you are preparing your budget for 2025, you can then say, okay, if we are able to we made 100 million naira in 2024. In 2025, we should be able to do 10% or 15% over what we did last time in 2024. So you are using your past experience in the market to project the future outcome, right? But the prevailing market condition can limit the ability of the company to achieve that particular expectation. All right. If there's inflation, what you tend to achieve in that 2025, maybe you may not achieve the exact, you may not meet up with your expectation because of inflation. Government policy, all right, government policy can affect, which is beyond the company's control, can affect or impair the ability of the company to maximize return or profit. Okay, so all of these are what you are supposed to incorporate in the cash flow estimates when a company is undertaking a project, because you don't want to be overly optimistic. You don't want to be overly optimistic. Look at what happened in 2020 during COVID-19. Nobody saw it coming, right? And it just happened. Every business in the economy, every business in the world were affected with COVID-19. Businesses had expectation for that particular year. And to a large extent, most companies could not achieve their targets because of COVID-19, because business could not operate as they normally do. All right. So these are the things that this topic is trying to help us to achieve, because we don't want to be overly optimistic that, okay, that 10% that we say we are going to achieve, we have to achieve it. Yes, it's good for you to plan, but when you have some factors that are beyond your control, there's nothing you can do about it. Therefore, it is essential that decision makers incorporate the element of risk and uncertainty involves in the variability of cash flow when making investing decision. You have to incorporate it. What if this does not happen? What's the worst case scenario? All right. All of these are what risk and uncertainty wants to achieve. Now, what do you mean by risk? Okay, what is risk? Risk is a situation whereby the future outcome is unknown, but it can be predicted with past experience and probability of occurrence. Okay? Risk is also a possibility that all or parts of the original investment may be lost. All right? A company may lose original investments or part of the original investment. That's a risk. All right. So when you are using your past experience to project the future outcome, that is a risk. On the other hand, uncertainty will occur when future outcome cannot be predicted with past experience and probability of occurrence. That is uncertainty. That means the future is not certain, it's bleak. All right. So that is that. However, in finance, both risk and uncertainty are used interchangeably. Both risk and uncertainty are used interchangeably, even though they are technically different, but together we use them as one. Okay? Therefore, what are the methods of incorporating risk and uncertainty? What are the methods of mitigating risk and uncertainty? There are a handful of them, but about 5 or 6 are what we are going to be discussing in this class. All right. So you can just have a look at all of them. Have a look, and then you can master them. But at this level, examiner cannot be asking you what are the method of mitigating risk. It's expected that you know it. All right. However, we are going to discuss expected value method. We are going to discuss standard deviation and coefficient of variation. We are going to discuss simulation. We will also discuss sensitivity analysis as well as a decision tree. All right. So these are the 5 methods of hedging risk and uncertainty that we are going to discuss in this class. All right. So every other ones, some of them we have discussed it in the past. Some of them we have done it at financial management, under financial management. But for the purpose of this class, we only touch base on those 5 items that I ticked. Okay, so let's talk about expected value. So please open to the material at your end. What do you mean by expected value? Expected value is also known as mathematical expectation or Bayes theory. Okay, it's also known as mathematical expectation or Bayes theory. Let's talk about Bayes, B-A-Y-E-S, Bayes theory. All right, it involves averaging the possible outcomes. All right, expected value involves averaging the possible outcome. Expected value can be computed by multiplying the probability of occurrence with the possible outcomes. So the possible outcomes are the cash flows or returns or benefits or receipts associated with the project. All right. So to calculate expected value, you are supposed to multiply probability with the cash flows or possible outcomes. The expected value method is mostly preferred by risk neutral decision maker or individual or investor or manager. All right. Because as a risk neutral does not seek or avoid risk, he or she is willing to accept any outcome under any condition or state of nature. All right. So like I said, the expected value method is mostly preferred by a risk neutral individual. This is because a risk neutral decision maker does not seek or avoid uh, risk, and he or she is willing to accept any outcome under any condition or state of nature. So, where two or more alternatives are being considered, any alternative with the highest expected value should be selected. That is expected value. So to calculate expected value, like I said, you are supposed to multiply probability with the cash flows, and then you sum up your result. That's basically that. All right. Now, particularly at this level, examiner can ask you to calculate expected NPV. All right. So how do you compute expected NPV? The expected NPV is computed as the normal NPV, except that expected value is used to calculate the NPV. First thing first, if you're asked to calculate expected net present value, all right, you need to first of all calculate expected value by multiplying probability with the cash flow. All right, you multiply probability with the cash flow. So whatever you have thereafter, that will give you the expected value. So you then use the expected value that you have computed to go and calculate your NPV. The result is known as expected NPV using expected value method. All right, so that's that. So before we move to standard deviation, let's have an example to demonstrate how to estimate expected value. Remember what I said. Anytime you want to compute expected value, you are supposed to multiply probability of occurrence with a possible outcome. The possible outcome is the cash flow of receipt and payment. All right. So you multiply probability with the cash flow to get the expected value. So if you are now asked to calculate expected NPV, then you need to first of all calculate expected value. You then use the expected value to go and compute NPV. The result is known as expected NPV using expected value method. Okay, so if that is the case, let's have illustration on this before we move to the next method. Yes, let's solve this illustration number one. Let's solve this illustration number one. Lewandowski PLC. You are required to analyze and evaluate the production of simple based on expected present value. Show all relevant calculation. So we want to calculate expected present value. All right. So one thing should call your mind from this requirement, you have to calculate expected present value. It means for you to be able to calculate expected value, you must expected present value. You must first of all calculate present value. You must first of all calculate expected value. And to calculate your expected value, you need probability and cash flow. All right, you need probability and cash flow. And remember, probability is always attached to state of nature, and the state of nature is the event in the economy. In the economy, you can have good, bad, worse. You can have most likely, optimistic, pessimistic. You can have high, medium, low. All right. You can have boom. steady states, you can have a recession. So those are the states of nature. So in case you are not given probability in the question, you are going to use the state of nature to form the probability. All right, you are going to use the state of nature to form the probability if you are given a value for the state of nature. But if probability is given to you directly, no worries, just go ahead, multiply probability with the cash flow to get your expected value. Once you have your expected value, you then go ahead to calculate the expected NPV. Therefore, let's go back to the body of the question. Lewandowski PLC. This is on page 62, illustration number 1. Lewandowski PLC, a manufacturing company located in the eastern part of the country, designs and manufactures personal stress monitoring device. The device has a commercial life of 3 years. Okay. As a result of wide advertisement campaign, the company recorded high sales for the 2 years, while the sales figure for the third year went down substantially due to low demand for the product. The marketing department of the company was assigned the responsibility of finding out the reason for low demand. The department discovered that the consumer complained of the low quality of the product, which makes it less durable. Okay. With this information, the company decided to submit 200 samples of devices to the Quality and Assurance Department of the company for analysis. Out of the 200 devices submitted, 50 enjoyed an above average demand, 120 enjoyed average demand, and the remaining 30 enjoyed below average demand. This demand pattern is applicable in all the company's products. Recently, the company developed a new device known as Simple, and paid 10 million naira as development cost. Okay, that's a sunk cost. All right. The following projections were made in respect of the product Simple. So you are given sales revenue for year 1 to 3 under each state of nature. Variable cost will amount to 30% of sales. All right, we have variable cost here. Sales revenue and variable cost will be received and paid respectively on the last day of each year in which they arise. That means at the end of each year. If Simple is produced, a special machine will have to be purchased at the beginning of year 1 at a cost of 190 million naira. That's initial outlay. Payable at the time of purchase. The machine will have a scrap value of 10 million naira, okay, at the end of the product life. The amount is receivable 1 year after the last year in which production takes place. So this scrap value will not be received until 1 year after. Okay, that means at the end, after 1 year after year 3. So that means year 4. If purchased, the machine will be installed in an unused part of one of Lewandowski's factories. The company has been trying to let this unused factory space at a rent of 16 million naira per annum, although there seems to be no chance of letting the space in year 1. There is a 60% chance of letting it for 2 years at the beginning of year 2 and a 50% chance of letting it for 1 year at the beginning of year 3, provided it has not been let at the beginning of year 2. All rental income will be received annually in advance. Fixed costs, which include depreciation of the special machine on a straight line basis, are expected to amount to 70 million naira per annum. So we have a fixed cost, and these fixed costs include depreciation of 70 million naira. All right. So include a depreciation. We don't know the value of the depreciation. We have to calculate that. But the fixed cost is 70 million naira per annum. All right. So we see how we are going to treat that information. The costs, which are all specific to production of simple and with the exemption of depreciation, will be paid on the last day of the year in which their advertising expenses will be paid on the first day of each year and will amount to 30 million naira. We have advertisements expenses. Okay. 20 million at the start of year 2 and then 10 million at the start of year 3. Lewandowski PLC cost of capital is 20%. All right. So that is the question. That is the question. So if that is the case, what are you supposed to do to solve this question? Examiner wants you to analyze and evaluate the production of simple based on expected present value. So you want to calculate expected net present value. What are you supposed to do? I've already explained to you what you need to do. First thing first, you need to calculate expected value. In this question, you are given sales revenue for year 1, year 2, and year 3 under each state of nature. All right? Under each state of nature. So, first thing first, you need to calculate your expected sales. How do you calculate expected sales? You need to multiply all the cash flows you have here by the probability of occurrence. In this question, we are not given probability. Therefore, what are we supposed to do? There's no probability in the question. So, but we have state of nature. Examiner has told us in the second paragraph that the company has taken a sample of 200 of devices to the quality and assurance department of the company. Out of the 200 devices, 50% enjoyed above average demand, 120 enjoyed average demand, and the remaining 30 below average demand. So that's what you are going to use to form your probability. Let me stop sharing this because of time. Let's move to the working notes quickly. All right. This is solution. So illustration 1. That's page 63. Let me check. Is it 63 or 64? 62. Page 62. The name of the company is Lewandowski PLC. So you are asked to calculate. I would then say calculating expected net present value. Let's restrict our numbers to million. Okay. So according to the question, the useful life of this project is for 3 years. So you then do for year 0, year 1, year 2, year 3. But we are told that the scrap value will not be received until the 4th year. Therefore, this will be extended to the 4th year. Then we go back to the question to go and do our workings. So I will then come here. I want to calculate expected NPV. Therefore, what am I supposed to do? First thing first, I need to calculate expected sales. Once I get my expected sales, I will calculate expected variable cost because the examiner told me that variable cost is 30% of sales. So that means what is most important is for me to calculate the expected sales. To get my expected sales, I need to multiply probability with the sales value for each year. But in this question, I'm not given probability. So that's a constraint. So how do I calculate my probability? I will then go to the question. I need to ask, am I given state of nature? Yes, I'm given state of nature. Under the state of nature, we are given for the state, we have three states of nature. One is above average demand, the second one is average demand, and the third one is below average demand. And the examiner has told us that they have taken a sample of 200. All right, out of the 200, 550 enjoyed above average demand, 120 average demand, then the balance of 30 below average demand. So that's what you are going to do. So first thing, come here, do your probability. Okay. So we have the states, then we have the demand. We have the states for states above, working for probability, then the probability. All right, so we have average. We have below average. All right. Okay, let me just put table. Let me put it in a table. So at all time, your probability must be equal to 1. If it is not equal to 1, you have to make it equal to 1. It's a must. All right, so 50 enjoyed above average. 50 out of 200 are samples. Then 120 out of 200 samples enjoyed average. The balance of 30 enjoyed below average demand. So 50 50 divided by 200. That will give us 50 over 200. That's
0.25.
0.25. Here is 0.25. Then 120 divided by 200, 0.60. Then 30 over 200 should give us 0.15. So at all time, your probability must be equal to 1. So now that you have the probability, then the road is clear. Then working number 2, we need to calculate expected sales. Expected sales revenue. How do we get the expected sales revenue? Just multiply probability with the cash flow. That's all. All right. We said expected value equal to summation of probability of X. That is, multiply probability with the cash flow. That will give you the expected sales. Therefore, we create a column for states of nature. Then another column for probability. Then you are going to have the number of years. All right, you are going to have the number of years. So let's say we have year 1. We also have year 2. Then we have year 3. So we can merge everything together since they have the same probability. So we have above average, then below average. Probability of 0.15, sorry, 0.25. 0.60, then 0.25. 15. All right, so we divide this into 2. We divide each year into 2. Okay? If you like, you can say this is P. Expected value. All right. So, to get the expected sales, you are supposed to multiply probability with the cash flow. This will give you expected value. Cash flow multiplied by cash flow to get the expected value for each year. So that's that. So I will then go back to the question. For year 1, what's the cash flow of year 1? 240, 140, 50. 240, 140, then 50. To now get the expected value for year 1, we then multiply the probability of 0.25 with 240, and that produced 60 million. Then the second state of nature, 0.6 multiplied by 140 equal 84. The next one, 15.15 multiplied by 50, that's 7.5. You then add it up. That will give us 144 plus 7, that's 151.5. Okay? Then we move to year 2. Cash flow of year 2, 500, 340, 180. 500, 340, 180 million. We then use that to multiply probability. Therefore, 0.25 multiplied by 500 equal 125. Next, 0.6 multiplied by 340 equal 204. 0.15 multiplied by 180 equal 27. So 27 plus 204 plus 125, 356. Expected value for year 2 is 356 million naira. Then the cash flow of year 3, 160, 80, 50. 160, 80, then 50. Use that to multiply the probability. 160, okay, 40,
48,
and then
7.5,
7.5. That will
totaling
give us
95.5.
95.5. Thank you. Now that we have the expected sales, we are good. If you would like, we can go on and post the expected sales for year 1, year 2, and year 3 in our table if you want to follow that route. So if you want to do that, then after you have posted your sales value, expected sales value, you then multiply 30% to get the variable cost. Then you continue with your calculation. But I will not do that because I know that sales minus variable cost will give me contribution. Therefore, because that method will be faster for me. If sales minus variable cost is if variable cost is 30%, it means that contribution will be 70% of sales. Therefore, I will then go up there and post for contribution. So I can say contribution at 70% of sales. Therefore, sales in the first year is
151.5 times
151.5 multiplied by 0.7.
106.05.
That is 106.05. For year 2, we have expected sales of 356 multiplied by 0.7. What do you have?
249.2. 249.
249 point what?
0.22.
0.2. Okay. Then year 3 is 95.5 multiplied by 0.7.
66.85.
0.85. So that's our contribution. With this, we have saved about one or two lines. Then move to the next one. So let's go back to the question. Let's go and identify other relevant cash flows. All right. So after the sales, before the sales, we are given a sunk cost, development cost of 10 million naira. And we said it's a sunk cost because that 10 million naira is a past cost. It's not relevant to the calculation, so we ignore it. So after variable costs, we also have the next paragraph that follow. We are told that if simple is produced, a special machine will have to be purchased at the beginning of year 1 at a cost of 190 million naira. That represents the initial outlay. We'll use that one later on. All right. So we are also told that the machine will have a scrap value of 10 million naira at the end of the product life. And we are told that this will be received in the 4th year. All right. So again, we are going to use that information later on. Then we also have unused factory space. So if you go to the third paragraph after the table, examiner told us that although there seems to be no chance of letting the space in year 1, all right, there's a 60% chance of letting it for 2 years at the beginning of year 2. Remember, this factory space is where you are going to install this project. All right, that's where you are going to install the machine. But you are now told that this space, there's a 60% chance of letting it for 2 years at the beginning of year 2. Pay attention, please. So that means there is going to be opportunity cost on rent because you cannot let it out. You cannot let out that unused factory space because that's where you want to install the machine. So you can't receive the rental income. So that's an opportunity cost. However, you are told in the question that there is a 60% chance of letting it for 2 years at the beginning of year 2. Beginning of year 2 simply means end of year 1 because before you can recognize a year, you have to count 12 months. If you say beginning of year 2 is just end of year 1. All right. So, and then for 2 years. Therefore, let's go and do working for this to save time. So I will then come here working number 3. Opportunity cost on rent. So we are going to do for year 1, year 2, and then year 3. Now pay attention. We are told that there's a 60% chance. Chance simply means probability. You can call it chance or events. It's the same thing as probability. So you are told that there's a 60% chance of letting it for 2 years at the beginning of year 2. And I said that beginning of year 2 simply means end of year 1, because before you can help recognize a year, you have to count 12 months, January to December. So if you say beginning of year 2, that is at the beginning of 2025, for example, beginning of 2025 is January, maybe 1st of January. So you cannot say 1st of January is a full year. That's not possible. All right. So when you are told that beginning of a year, if you say beginning of year 1, beginning of year 1 simply means year 0. Beginning of year 2 means end of year 1. Beginning of year 3 means end of year 2. So you continue in that order. All right then. So we have a 60% chance. So you then come here 60%. 16% is the same thing as 0.60. So there's a 60% chance of letting it for 2 years at the beginning of year 2. Therefore, I would then say 60% multiplied by the 16 million naira. What do you have here, Tosin?
9.6.
9.6 for 2 years. So here will be 9.6, 9.6 dash. Now, you know that probability must be equal to 1. That is, must be equal to 100%. So you have let out 60% out of the 100%. That means you have a balance of 40%. In the question, examiner did not give you balance of 40%. You are told that, and a 50% chance of letting it for 1 year at the beginning of year 3, provided it has not been let at the beginning of year 2. Of course, 50% has not been let out at the beginning of year 2, so that is out of it. Now, you are told there is a 50% chance of letting it for 1 year at the beginning of year 3. Beginning of year 3 simply means end of year 2 for 1 year only. Therefore, I will then come here. In my first allocation of 60%, out of 100%, I've allocated that 40%. So that means I have a chance of 40% left. Out of 100%, there's a 60% chance. We have taken out 60%, we are left with 40%. Therefore, I will then say 50% of the balance of 40%. So here will be 50% of the balance of 40%. This will give us 0.20. Then multiply by the rent of 16 million. So what do we have here?
3.2.
That should be 3.2 for 1 year at the beginning of year 3. For 1 year at the beginning of year 3. So, and I said that beginning of year 3 is simply end of year 2. So here will be 3.2 for only 1 year. So this one will be dash. Now, ordinarily, I'm supposed to close this because that's the end of it. I've interpreted the scenario given to me on this paragraph. But my probability has not made up 1 or 100%. So I need to do the balance of 50% of the 40% to give me 0.2. This will then make my probability to be equal to 1. If you ignore that information, no problem. I've gotten what I'm looking for. So this third one, it has nothing to do with our calculation. It's just to make your probability equal to 1. All right. Therefore, I need to determine the total. All right. So here will be 9.6. Here will be 12.8 dash. So that is the opportunity cost on rent. So you have to know, you have to shine your eye and open your mind. Don't box yourself because you must know how to interpret a question. You can see in this question, in the first statement, we are told that there is a 60% chance of letting it for 2 years at the beginning of year 2. And we said beginning of year 2 is end of year 1. And then for 2 years. So you take 60% of the 16 million naira rent. That's what gave us 9.6 for 2 years. And you are told that there's also a 50% chance of letting it for 1 year at the beginning of year 3, provided it has not been let at the beginning of year 2. And we said that beginning of year 3 is end of year 2. You cannot do 50% of 16 million because if you do 50% of 15 or 16 million, you are going to do more than the 100% because in the first year you have taken out 60%. You're only left with 40% balance of the probability. Therefore, you are supposed to do 50% of the balance of 40%. That's what gave the 0.2. You then multiply the 0.2 with the rent of 16 million. So you get the 3.2 for the second year. Of course, the third probability that I will have there, it has nothing to do with our calculation. It's just to ensure that we have our probability equal to 1. So you have done 60%. You have done 60%, 0.6. You have also done 50% of the 40%, which is 0.2. Then you have to do the balance of 50% of the 40%, which is also 0.2, just to make it equal to 1. So that's that. Then let's go and post. Opportunity cost. This is working. Number 2, 9.6, 12.8. Okay, so let's go back to the question. Yes, still on the same paragraph. You are told that fixed costs, which include depreciation of the special machine on a straight line basis, are expected to amount to 70 million naira per annum. These costs, which are specific to production of simple and with the exemption of depreciation, will be paid on the last day of the year. All right, so we are given specific fixed cost of 70 million naira, but we are told that this 70 million naira included depreciation. And you know that depreciation is a non-cash item. Therefore, we need to go and calculate the relevant fixed cost in this case by deducting depreciation from the 70 million. Okay, so that's what we are going to do. All right. So let's calculate working for the specific fixed cost, working number 4. So we have a fixed cost of 70 million naira. And we're now told that this 70 million naira included depreciation. Remember what I told you when I was explaining relevant cash flow under capital budgeting. I told you that there are 3 different ways examiner can test you on fixed costs. If you are given fixed costs, no further information, no additional information, I said that fixed cost is irrelevant because fixed costs are costs that have no sympathy for activity level. Irrespective of production volume, fixed costs will not change. So provided fixed cost will not change, it is irrelevant. Number 2, I said if you are given fixed cost, including depreciation, that fixed cost is not relevant. However, you need to calculate annual depreciation and less from the fixed cost. Whatever you have thereafter is relevant. Then number 3, if you are given fixed cost, excluding depreciation, examiner told you that fixed cost excluding depreciation, so that fixed cost is relevant. You have to account for it. So this particular 70 million, we are told that it included depreciation. Therefore, we need to calculate annual depreciation and then less. Depreciation is cost minus scrap value divided by useful life. So in this case, the cost of this machine is 190 million. Scrap value is 10 million. Useful life is 3 years. Therefore, what do we have here? 190 minus 10, that's 180. 180 divided by 3, that's 60. Therefore, annual depreciation is 60 million. So 60 million, 70 million minus 60 million will give us 10 million naira. So our specific fixed cost is 10 million naira. So we then go up there and post it. Annual specific fixed cost. Working number 4. This is working number 3. All right. So 10 million naira, cash outflow, cash outflow. So let's move on. Let's go back to the question. In the same paragraph, you are told that advertising expenses will be paid on the first day of each year. First day of each year simply means, like for example, when you say 1st of January, so that means at the beginning of each year. All right. Therefore, and we amount to 30 million naira at the start of year 1. Start of year 1 is year 0. So there is 30 million advertising cost in year 0. 20 million at the start of year 2, which is end of year 1. 10 million at the start of year 3, which is end of year 2. So let's go and indicate that advertising expenses. Okay, so 30 million at the beginning of year 1, which is which is year 0. 20 million at the beginning of year 2, which is end of year 1. Then 10 million at the beginning of year 3, which is end of year 2. All right. So what other costs do we have in the question? All right, I think that's it. That's it. So at this point, in the question, we don't have anything like tax. There is no tax. Therefore, let's move on. If you like, you can determine the taxable profit since there is no tax. So you can just indicate your initial outlay and then you have your, indicate your initial outlay, your scrap value. But if you have tax, you need to first of all determine the, let me just do that. So here is 30. Please, on the day of your exam, don't do this. It's a waste of time because you already know in the question that there is no tax. So if there is no tax, just determine your net cash flow, discount the net cash flow, get your present value, then get your NPV. That's all you need to do. Don't go and be doing profits. It's a waste of time. You are still doing profit. Your other colleagues have moved to the next question. All right. So I'm only doing this in case you have tax in the question. So 106.05 minus 9.6 minus 30. That's 66.45. Then 249.2 minus 32.8. That's 216.4. Then this one will be
56.85.
85. So that's a taxable profit. If you have tax rates, just multiply on the profits. But we don't have that. So you then include your scrap value now. Scrap value is 10 million naira. And we are told that this 10 million naira will not be received until 1 year after the end of the project, which is year 4. Then we have initial outlay. Initial outlay is 190 million. If you have working capital in the question, you then include it, but we don't have. Therefore, at this point, we then determine the net cash flow. Here is 10, 56.85, 216.4, then 66.45. Here is 220. So don't forget what I said. Once you discover that there's no tax rate in the question, there's no need for you to be determining to determine profits. Just determine your net cash flow, discount it, get your present value, then get your NPV. Move on from there. No time to waste at all. You have to keep moving. So now that we have the net cash flow, we need to discount it. Examiner has given us cost of capital of 20%. Therefore, what is discount factor of year 1 at 20%?
0.833.
0.833. Year 2.
0.694.
Year 3.
0.578 or 579.
579. Year 4.
0.4822.
4822. 482. Then we multiply to get the present value.
55.35.
55.35.
150.18.
150.18.
32.916.
32.196.
No,
So
no,
that's 32.
32.916.
Okay, 916. That's 92. All right. So final answer.
I'm coming.
All right. 32.92 plus 4.82 plus 150.18 plus 55.35 equal minus 220 equal
23.26. Please confirm. 23.26. Let me get it.
23.26.
Let
All
me
right.
get
We
it.
then say the expected NPV of the project is 23,260,000. That's it. That's it. That's what examiner wants you to do. You have to analyze and evaluate the production of simple based on expected value. Show all relevant calculations. We have done all of that. All right. If you like, you can then you have to state your assumptions. Okay, you state all your assumptions. Assumption number 1, talk about cash flow. Assumption number 2, we talk about cost of capital. We are given cost of capital of 20%. All right. Then number 3, talk about depreciation. Number 4, we talk about sunk cost. We are given development cost of 20%. Sorry, of 10 million naira. All right. So any other assumptions that we have made in the question, we speak about them. You already know what to do under cash flow, under cost of capital, under depreciation, under sunk cost. We have done this in the past. So for you to be able to earn your full mark, you just have to state your assumption. You can't just stop at your recommendation. All right. Of course, you can then say the projects is financially viable and should be undertaken. Should be undertaken or accepted. That's it. You then state your assumptions. All right, so that's end of the question. Let's move to the next one. Let me know if you have any question on this before we move to the next. We are moving to standard deviation now. Any question on this? All right then. So let's move on. Let me stop sharing this. Let's move on to let's go back to standard deviation. What do you mean by standard deviation? Standard deviation represents a statistical measure of absolute dispersion and is a measure of spread about mean value. Standard deviation is used to measure the risk associated with a project. And then the higher the standard deviation, the more risky is the project. Where two or more alternatives are being considered, any alternative or projects with the lower standard deviation should be undertaken. Of course, this will also be consistent with the return associated with the alternative or project. So like I said, standard deviation is a statistical measure of absolute dispersion and is a measure of spread about mean value. We use standard deviation to measure the risk associated with a project. And then the higher the standard deviation, the more risky the projects. And I said where two or more projects are being considered, any project with a lower standard deviation will be preferred. That is better. However, this will be consistent with the return associated with the project. All right. Because the higher the return, the higher the risk, and vice versa. Okay. So how do you then calculate standard deviation? There are 3 different formulas that you can use to calculate standard deviation, depending on the information available. If in the question you are just asked to calculate ordinary standard deviation, then standard deviation is the square root of variance. You know, variance is calculated as summation of probability of x minus x bar square. This is the formula for calculating variance. Therefore, to now calculate standard deviation, you just need to find the square root of variance. That will give you standard deviation, and that's what you have here. Okay, so if you have to calculate ordinary standard deviation, this is the formula to use. However, in most cases, examiner can ask you to calculate standard deviation of expected NPV. Okay, standard deviation of expected NPV can be calculated using 2 different formulas, depending on whether you are given mutually dependent cash flow or independent cash flow. All right. So where you have mutually dependent cash flow, first thing first, before we talk about how to calculate standard deviation of NPV, where there is mutually dependent cash flow, you need to know what is mutually dependent cash flow. All right. So a mutually dependent cash flow is the one in which the events in each year is the same. Let me write that. Mutually dependent cash flow will arise if only one cash flow is provided or is given for the whole year. If only one cash flow is given for the relevant years. Okay, so that means it will be mutually dependent cash flow. So once you are given the same cash flow for all the years, it means that they are mutually dependent. It means that the event of each year is dependent of other years. All right? So that is mutually dependent cash flow. So where you have mutually dependent cash flow, then standard deviation of expected NPV will then be calculated as standard deviation computed multiplied by annuity factor. Or you can say standard deviation of NPV equal to standard deviation computed over 1 plus R raised to power N. All right, we find the summation. Summation of, yeah, so that is that. Of course, the DT, where DT equal to standard deviation computed all right. Okay, I already have it. No need for me to be stressing myself. It's already here. It's already typed out. All right. So DT is the standard deviation computed. So in this case, this standard deviation is the one you have above, which is standard deviation will then be equal to square root or summation of probability of x minus x bar. So you need to calculate, first of all, you calculate standard deviation using this formula. So that's your DT. All right, that's your DT. Okay, then calculate annuity factor. You calculate annuity factor, you multiply with the probability. So that will give you the standard deviation of NPV. Okay, so that's that. Then the second one is where you are given independent cash flow. So what do you mean by independent cash flow? Independent cash flow is a standalone cash flow in which the events of each year are different. Okay? Yes, Tosin, what's your question?
Sorry, sir. This formula of standard deviation,
Yep.
summation P x minus what is that, sir? Sorry, I'm not sure.
X minus X bar.
What is x bar?
You asked me what is X bar. Upon what we have done so far. Tosin, X bar is your expected value now. No, you have forgotten.
Ah,
See your life outside. Okay. So look at, look at this is where we are coming from now. Maybe, where is my expected value? See, look at where we are coming. Is this not the expected value you have here, Tosin? I know,
Yes,
X
sir.
bar. So that's your expected value. X bar is your expected value. Do you understand that?
Yes, sir.
All right then. So like I
Thank
said, the independent cash flow, like I said, independent cash flow, let me put it down for you. Hope this play will be sufficient for me. Let me try. Independent cash flow is a cash flow, it's a standalone cash flow in which the events of each year is different. So if the cash flow given for each year are different, that means they are independent. So if you are given independent cash flow, where you have independent cash flow, then the standard deviation of expected net present value will then be calculated as square root of variance of each year over 1 plus r raised to power 2t. Okay, 1 plus r raised to power 2t. That will give you the variance of, that will give you the standard deviation of NPV. Just multiply, you divide the variance of each year with 1 plus r raised to power 2 times t. That's it. That will give you the variance of each, that will give you the standard deviation of NPV. Now, of course, like I said, the DT simply means standard deviation calculated or computed. Then DT square or D squared T, however you want to put it, is the variance for each year. So this variance, you are the one that will calculate it. Remember, this is the formula for variance I've shown you before. I've shown you the formula for variance before. Why is that again? Yeah, this is the formula for variance. What you have inside this square root is the formula for variance. Okay, T is the time period. N is number of years or useful life. R is the company cost of capital. Then, of course, I did not use annuity factor. I wrote it out in full. So that's that. So these are the two different formulas that you can use to calculate standard deviation of NPV. This one, to use this one where you have independent cash flow. Then you use the second one. You use this one, either this, where you have mutually dependent cash flow. All right, so that's that. So that is how to calculate standard deviation and then standard deviation of NPV. So let's talk about coefficient of variation. The coefficient of variation represents a statistical measure of relative dispersion and is a measure of spread about mean value. The coefficient of variation is used to measure the risk inherent in a project, and the higher the CV, that is coefficient of variation, the higher the risk associated with the project. So in a situation whereby different projects with varying sizes are being considered, standard deviation may not be suitable, all right, to evaluate the project. Therefore, A more relative measure of dispersion should then be considered, which is a coefficient of variation in this case. So how do you then compose coefficient of variation? The formula you are going to use to calculate coefficient of variation will depend on your standard deviation and then expected value that you have computed. So if you have calculated standard deviation using this formula, that is square root of summation of probability of x minus x bar squared. So if you have used standard deviation, if you have used this formula to calculate standard deviation, and you also calculate expected value as summation of probability of x, and you are asked to calculate coefficient of variation. So in this case, coefficient of variation would then be equal to standard deviation over expected value. Okay? But if in the question you are asked to calculate standard deviation, you have calculated standard deviation of NPV. You have also calculated expected NPV. So in that case, and you are now asked to calculate coefficient of variation, therefore, coefficient of variation will be equal to standard deviation of NPV over expected net present value. Okay, so these are the two formulas that you can use to calculate coefficient of variation. So like I said, the formula you are going to use to calculate coefficient of variation will depend on the standard deviation and then expected value that you have computed. All right. So whichever one. So that's it. Just divide your standard deviation with your expected value, or standard deviation of NPV over expected NPV, to get your coefficient of variation. So that's that. At this point, let's have an illustration to demonstrate how to calculate expected value, variance, standard deviation, and then coefficient of variation. So please always raise your hand if you have any concern. Let me stop. Okay, let me continue with this. Let's just go for illustration. Yes, let's try illustration number 5, Tompolo. So you are required, that's the page 64, illustration number 5. Page 64, illustration number 5, Tompolo Limited. All right. So you are required to calculate 1, the expected net present value of the project, the standard deviation of NPV, and the coefficient of variation. Then go back to the body of the question. Tompolo Limited is considering whether to invest in a project which would entail immediate capital expenditure on equipment worth 40,000 naira. So initial outlay is 40,000 naira. The expected sales volume from the project are given below. All right, these are the sales volumes and probability. The unit selling price is 15 naira. Variable cost per unit is 9 naira. That means I need to calculate contribution per unit. Once sales are established at certain volume, in the first year, they will continue at that volume, at that same volume in the subsequent years. This simply means that they are mutually dependent. Okay, they are mutually dependent. The useful life of the project is 6 years, and the equipment would be sold for 5,000 naira after the end of the project. So we are given useful life to be 6 years, and we are given scrap value. Okay, we have a scrap value of 5,000 naira at the end of the project. The company's cost of capital is 10%. All right, so you are now asked to calculate expected net present value. Let me stop sharing this. Now, before that, now you want to calculate expected NPV. Like I mentioned earlier, to calculate expected NPV, you need to first of all calculate expected value. You then use the expected value to go and compute NPV. The result is known as expected NPV using the expected value method. That's what you need to do that. However, how do you calculate your expected value? You multiply probability with cash flow to get your expected value. When you look at this question, you will see that we are not given cash flow. We're only given sales volume. In that case, you need to go and calculate your cash flow. Once you get your cash flow, you then multiply with the probability. Once you get your expected value, then you go ahead and calculate your expected NPV. That's all you need to do. So to calculate the cash flow, you are going to, you take your selling price, you less variable cost of 9 naira, you have your contribution. You then multiply your annual your contribution per unit. You multiply with the number of units, sales volume. That will give you the cash flow. So let me stop sharing this and quickly move to solving the question. Okay. This is solution. Solution to illustration number 5, page 64. The name of the company is Tompolo Limited. So number 1 requirements, we have to calculate standard expected NPV. So I would then say calculating expected net present value. To calculate the expected net present value, I need to first of all calculate expected value. I will then use my expected value to compute my NPV. So let's say this page will be for expected value, standard deviation, then variance. So my workings will then follow. Let me start my working from here. I want to calculate contribution. Working number 1, contribution. So to get my contribution, I need to first of all calculate contribution per unit. Contribution per unit is selling price minus variable cost per unit. Selling price is 15 naira. Variable cost is 9 naira. Therefore, contribution per unit is equal to 6 naira. I will then go ahead and calculate total contribution. Okay. To calculate the total contribution, I have sales volume. I also have contribution per unit. Then I will have total contribution. Give me the sales volume, Tosin. 2018.
2000, 1008,
Okay.
1005,
Uh-huh.
2005, and
And then
1000.
1000. So we have computed contribution per unit to be 6 naira. So here will be 6. We then multiply 12,000. 18 multiplied by 6 will give us 10,800. Here will be 9,000, 15,000, and then 6,000. So now that we have the cash flow, we can then proceed to calculate our expected value. We need to calculate our expected value. Working number 2. I want to calculate expected value, variance, and then standard deviation. Okay. So to do this, we create a column for probability. If you are given state of nature, then of course you can indicate that, but we don't have it. Then we also have contribution. Our contribution is the cash flow. Then we are going to have the expected value, expected contribution. So this is P, contribution is X. This should be X bar. All right. So give me the probability, Tosin.
0.5.
Okay.
0.2.
Next.
Sorry, 0. The first one is 0.15. Sorry.
0.15.
0.2, 0.35, 0.1, and 0.2.
Please, like I told you, always ensure that your probability is equal to 1. If your probability is not equal to 1, then you can't have optimal solution. So 35, 35, yes, that's 1. So at all time, it may well be that there's a typo error in the question given to you. In this case, you need to call the attention of one of the invigilators that your probability is not equal to 1. At times, they may want to put a call through to their headquarters to seek for clarification. At times, the invigilators may use Ogboju to tell you that after all, that's not the only, you can go for another question. That's not the only question you have there. They will tell you to go and solve another question instead of that one if it's not clear to you. Or the best thing for you to make an assumption. All right. So if it's not equal to 1, you can make the last one to make it equal to 1. Or if it is more than 1, you adjust the last one. Always make adjustment on the last probability to make it equal to 1. Then you state your assumption. That's all you need to do. No need to stress yourself. You don't even need to call anybody. Just make assumption and move on. So here is our expected value. Now, our cash flow, we have calculated cash flow to be 12,000. Contribution is 12,000. 10,800.
9,000.
9,000.
15,000.
15,000.
And
And then
6,000.
6,000. So like I told you, to calculate expected value equal to summation of probability of X. You multiply probability with the cash flow. Therefore, 15% of 12,000 is what? Yeah.
18.
1,800. Then 20% of 10,800 should be
216.
2,160.
Yes.
Okay. 35% of 9,000 is what?
3,150.
3,150. Then add up everything. What you get?
I'm coming, sir.
Okay.
Well, 9810.
So expected value is 9810. That's it. That's our expected value, 9810. So before I begin to talk about variance and standard deviation, let's go and complete our expected NPV. So our expected value is 9810. This is what we are going to use to compute the NPV. So I will then come here, we create a column for year, description of items, we have cash flow, discount factor. What's the cost of capital given in the question? I think it's 10%. Yeah, 10%.
Yes.
Yeah, it's 10%. Then present value. The useful life of the project is 6 years. So we have year 0, initial outlay is 40,000 naira, multiplied by 1. That will give us 40,000. Okay, then the useful life is 6 years. So our cash flow is constant at 9810. So I would then say year 1 to 6, cash flow. If you like, I'll call it expected value or cash flow. We are still saying the same thing. 9810. At year 6, we have scrap value. We are given scrap value of 5,000 naira. Therefore, somebody should give me an annuity factor of year 1 to 6 at 10%. What do you have? Annuity factor of year 1 to 6 at 10%. Okay. Let me use my calculator. 1.1 raised to power 6 minus equal minus 1 equal divided by 0.1 equal, that's 4.355. 4.355. Then discount factor for year 6 at 10%. That's 1.1 raised to power minus 6. That's 0.564. 0.564. Okay? We then multiply.
42,725.
42,725. Okay?
Or you can do 42,722.5. It's 722. Sorry, do 42,723.
723.
Yes.
All right. Then 5,000 multiplied by 0.564.
2820.
2820. Okay. What's the final answer? That should be
5543.
543. So you can then say the expected net present value is 5,543 naira. That's it. This is how to calculate expected NPV. To calculate expected NPV, you first of all calculate expected value. You then use your expected value to go and calculate the NPV. The result is known as expected net present value. Now, the second part of the question, you have to calculate standard deviation of NPV. All right. So to calculate standard deviation of NPV, you must ask yourself, what is the nature of the cash flow? Because you want to be sure that you are using the appropriate formula. All right. Is this independent cash flow or mutually dependent cash flow? You will see that examiner has given us a clue in the question because you are told that once sales are established at a certain volume in the first year, they will continue at that same volume in the subsequent year. That means they are mutually dependent. So if cash flows are mutually dependent, then it means that the standard deviation of NPV we are going to compute. We are going to use the first formula I provided earlier. So to calculate standard deviation of NPV, we need to first of all calculate variance. Therefore, to get my variance, all right, variance is computed as summation of probability of x minus x bar square. This is the formula for calculating variance. Therefore, I will use this table to calculate my variance. To get my variance, I already have my probability, I have my cash flow, then I also have my expected value to be 9810. Therefore, I want to determine my variance, which is probability multiplied by x minus x bar squared. So to do this, I will then say x minus x bar, okay? I will also do x minus x bar squared. Then my variance will then be probability of x minus x bar squared. This is the variance. Therefore, I need to, now, my x is 12,000. I'm looking for x minus x bar. Therefore, the first x is 12,000. So 12,000 minus 9810. So let's use the calculator. 12,000 minus 9810. That is
2190.
2190. 2190. Then 2190 square.
Hmm?
2190 square. Um,
Four,
2190 square.
four,
That's
seven,
4796,100. 4796,100. Then multiply by probability of 0.15.
719,415.
0.719415.
415.
Okay, then move to the next one. 10,800 minus expected value of 9810.
990.
990 square.
980,100.
980,100. Multiply by probability of 0.2.
196,020.
196,020. Next one, 9,000 minus 9810. That will give us minus
Minus 810.
810. Minus 810 square is what?
656,100.
656,100. Multiply by 0.35.
229,635.
229,635. Next one, 15,000 minus 9810.
5190.
5190 square.
26,936,100.
100. Multiply by 0.1. That will give
Two,
us 2 million.
693.
693. Then 610. Okay. Next one. 6,000 minus 9810. That should be minus 3810. Minus 3810 square, uncle.
14,516,100.
40 million. 5 what?
16,100.
Multiply by 0.2. That will be 2,000,000.
903,220.
903,220. So let's add it up.
Okay. Okay.
Excellent.
Plus 26.
That is what? 6
6,741,41900. No, no, no. Instead of this four.
741,900.
Yes, please.
Okay. So that's that. Therefore, our variance is 6,741,900. 6,741,900. Because the cash flow is mutually dependent, then we need to calculate standard deviation. Standard deviation would then be equal to square root of variance. And our variance is summation of probability of x minus x bar square. Therefore, what is square root of 6,741,900? Give it to me.
2596.5.
2597. Okay, so that's the standard deviation. This is ordinary standard deviation. So to now get the standard deviation of NPV, I will go back to my main page. I want to calculate standard deviation of NPV, requirement number 2. I will then say calculating standard deviation of net present value. So standard deviation of NPV will be computed as standard deviation multiplied by annuity factor. Okay, therefore, we have calculated standard deviation to be 2597. We also calculate annuity factor to be 4.355. Let me confirm that. 4.355. Therefore, the standard deviation of NPV would then be equal to 2597 multiplied by 4.355. This is 11,310. 11,310. So that's the standard deviation. If I don't want to use annuity factor, I can say alternatively, this one is longer. So if you like, you can say standard deviation of NPV equal to the standard deviation computed over 1 plus r raised to power n. So if you want to follow this route, so this one will be longer. Let me see. Okay. So this method will be longer. So in this case, this will then be, you pick the standard deviation you have computed, which is 2597 divided by 1.10 raised to power year 1 plus 2597 divided by 1.10 raised to power year 2. plus 2597 divided by 1.10 raised to power year 3. You continue to do that until you get to the last one, which is year 6. 2597 over 1.10 raised to power year 6. So why should we be doing all of this when you have a shortcut to use? All right. So your shortcut, just because the denominator is your discount factor for year 1, discount factor for year 2, discount factor for year 3, up to year 6. Just calculate annuity factor, multiply with the constant cash flow, and then you move on from there. That's all you need to do. All right. So this one is long, guys, to waste your time. Okay. So, however, whether you use this or you use the first one, you are going to get the same answer. All right. So number 3, we are to calculate coefficient of variation. So calculating coefficient of variation, CV. And we said that CV, the formula that you are going to use to calculate your CV will depend the formula you are going to use to calculate your CV will depend on the standard deviation that you have computed and then expected value. So because we have calculated standard deviation of NPV, so I can then say standard deviation of NPV over expected NPV, which is equal to 2597 divided by 5543. So what do we have here? Sorry, it's not 254. Our standard deviation of NPV is 11,310. 11,310. So that will be 2 point what? Tosin. Tosin, are you still there for me?
Yes,
Okay.
sir. 2.04.
2.04. So that's the coefficient of variation. So that's that. So let's have one more illustration, and that's where we are going to stop. So let me know if you have any question for me. Let's switch. Let's switch to the learning material to have one more illustration on this. Let's solve a question whereby you are given independent cash flow. How do you calculate the standard deviation? Let's have that. Okay. So let's have another illustration. Let's solve illustration number 4. Still on page 63, illustration number 4. Barcelona Limited has an investment proposal that has the following probability distribution of returns. The events of each year are independent of other years. The outlay on the project is fixed at 22,000 naira, and the appropriate discount rate is 10%. You are required to calculate 1, the expected net present value, 2, the variance of return in each of the years, 3, the standard deviation of net present value, and 4, the coefficient of variation. So that's it. So based on the one we just solved, let's switch to working notes within the next few minutes. Let's solve this and then end the class. All right. This is solution to illustration 4, page 63. The name of the company is Barcelona Limited. Okay. So number A requirements, you have to calculate expected net present value. We want to calculate expected net present value. So number 1, calculating expected net present value. So to do this, we need to first of all calculate expected value. We then use the expected value to compute NPV. So let's say this page will be for expected NPV, standard deviation, then coefficient of variation. So let's move to working notes. Next page. So let's do our workings here. Working number, we want to calculate. I can say calculating expected value and variance. All right, expected value and variance. So in the question, the examiner has told us that the events of each year are independent of other years. In fact, even if the examiner did not mention that statement, when you look at the return of year 1, return of year 2, and then return of year 3, you see that they are different. So because the cash flow of each year are different, that means they are independent of other years. So in this case, we are going to use the second formula to calculate the standard deviation of NPV. But before we get to that point, we need to first of all calculate expected value and then variance. So I would then say probability return. Okay, let's say this is for year 1. So probability return denoted as X. Then we have expected return denoted as X bar. Then because we want to calculate variance, we are going to have X minus X bar, then X minus X bar square, then probability multiplied by X minus X bar square. So for year 1, Tosin, give me the probability.
0.2.
0.2, 0.4,
Or
and then
0.4.
0.4. So always remember that your probability must be equal to 1. Okay. Then the return.
6,000,
Uh-huh.
8,000, nine
And
thousand.
9,000. We then multiply to get the expected return. This is 1,200,
1,
32, then
3,
36.
6.
When you add it up, expected value is 8,000. All right, so let's just complete the table. . This will be the variance of year 1. So, x minus x bar, 6,000 minus 6,000 will give us minus 2,000.
2,000.
Minus 2,000 squared will give us 4 million. 4 million multiplied by a probability of 0.2, that's 800,000. 8,000 minus 8,000 will give us 0. 9,000 minus 8,000 is 1,000. 1,000
1,000.
squared is 1 million. 1 million multiplied by 0.4 will give us 400,000.
400,000.
So when you add it together, that's 1,200,000. Variance of year 1 is 1,200,000. We do for year 2. Okay, so we have the
0.5.
probability, we have the return, we have expected value, we have x minus x bar, we have x minus x bar square, then we have p of x minus x bar square. Yes, you said we have what?
0.5, 0.5.
0.5, then 0.5. What about the return?
8,000, 12, and is it 1, 2 of 12,000?
That's 12,000.
Okay.
12,000. All right. So here will be 4,000, then
6,000.
6,000, 10,000. That's the expected value. All right, so x minus x bar, 8,000 minus 10,000, minus
2,000.
2,000. Minus 2,000 squared is 4 million.
4 million.
Multiplied by a probability of 0.5, that's 2
2
million.
million.
12,000 minus 10,000 is 2,000. 2,000 squared, 4 million. Multiplied by 0.5, 2 million. Total is 4 million. This is variance of year 2. Then year 3. So probability, return,
0.3.
0.3,
0.5.
and then
0.2.
0.2 equal to 1. Give me the return.
2001. 55.
5, 5. Are you sure?
34.
Which one? What are you calling? I said give
Oh,
me the return. 7,000,
7,000.
11,000,
Sorry.
17.
Yes, I was multiplying. Sorry. 7,000, 11,000, and 17,000.
7,000, 11,000,
11,000 and
and then
17.
17. So here will then be expected value will then be equal to 2,
5,
5,
5,
5,
3, 4.
and then 3, 4. When you add it up, that's 11,000.
11,000.
That's expected value. Therefore, you then do x minus x bar, x minus x bar square. Then probability of x minus x bar square. All right. Therefore, 7,000 minus
11,000.
11,000.
4,000.
That's minus 4,000. Minus 4,000 square will give us 16 million.
16.
16 million multiplied by 0.3. That's
4.8.
4.8. 11 minus 11,000, 0.
0, 0, 0.
17,000 minus 11,000, 6,000.
6,000 square.
6,000 squared, 36 million. Multiply by
0.8.
0.2,
7.2.
7,200,000. When you add it up, that's 12 million. That is variance of year 3. So now that we have computed the variance, we can go back to complete our calculation. We calculated expected value in year 1 to be 8,000, expected value of year 2, 10,000, expected value of year 3 to be 11,000. So we can go ahead and complete the question, the requirements. So create a column for year, description of item if necessary, then we have cash flow. Discount factor at 10%, then we have the present value. Year 0, 1, 2, 3. We don't have scrap value in the question, so you ignore. So initial outlay is 22,000. 1, 22,000. So we have cash flow for year 1 to be 8,000. That's our expected value. In year 2, we calculated expected value of 10,000. Year 3, 11,000. Discount factor at 10% for year 1 is 0.909. Year 2, 0.826. Year 3 is 0.751. We then multiply 8,000 multiplied by 0.909. That should be 7272, I think. Please confirm. Here is
Yes.
8260. Then 11,000 multiplied by 0.751 should be 8261, I think. Yeah, add it up.
8261.
Expected MPB is what?
1793.
1793. So you can then say the expected net present value is 1,793 naira. The number 2 requirements, we have to calculate variance. We have done that already. We have to calculate variance of return in each year. So I can say variance of return. Okay. So we have for year, then variance. Year 1, year 2, year 3. In year 1, variance is 1,200,000. Year 2, 4 million. Then in year 3, 12 million. Don't always be in a hurry. Your table on the day of your exam, always ensure you complete your table. Don't rule one side and leave the other side. That's not a good presentation. Always ensure you complete your table. Then, number 3, standard deviation. All right, so to calculate the standard deviation, we then go back to the question, how do we calculate our standard deviation? What's the nature of our cash flow? Are we given mutually dependent cash flow? or independent cash flow? So according to the question, we are given independent cash flow. Since we have independent cash flow, then standard deviation of expected NPV will be computed using the second formula. And the second formula states that standard deviation of NPV is computed as the square root of variance of each year over 1 plus r raised to power 2t. So in this case, I would then say variance of year 1. Let me move to the next line. Variance of year 1, we have 1.2 over 1 plus 1 raised to power 2 times 1. 1.1 raised to power 2 times year 1 plus 4 million divided by 1.10 raised to power 2 times year 2 plus 12 million over 1.10 raised to power 2 times year 3. Then you find the square roots. All right. No space again. I underestimate the space. Let me see if I can manage. All right. So standard deviation of NPV would then be equal to 1.2 divided by 1.1 raised to power 2. That will give us 1.21 plus 4 million divided by 1.1 raised to power 4. That will be 1.4641. Please always confirm the numbers. Then 12 million divided by 1.1 raised to power 6. That's 1.771561. We then find the square roots. Okay? So this is what you are going to do to get the final answer. You don't need to be doing it one by one. That's a waste of time. You can't be doing it one by one. So in this case, you carry your calculator, right? Open a bracket. You then say 1.2 million divided by 1.21. Close the bracket. Plus, open another bracket. 4 million divided by 1.4641. Close the brackets. Plus, open another bracket. 12 million divided by 1.771561. Close the brackets. Then press equal to, you have 95 something something. Then find the square roots.
I have 10,497.
Yeah, it's I think. Oh, okay. I made a mistake somewhere here. It's supposed to be 10. Then you find the square root. What does it give you? 3, 2. Press square roots. What do you have there?
10,497,477. 102.457.
What do you have? Find the square root of your answer.
102.457.
That's not correct.
Okay.
Have you found the square root?
Yes.
No, that's not correct. Let me redo it.
Let me
Open
redo
a
it.
bracket. 1.2 million divided by 1.21. Close the bracket. Then plus, open another bracket. Okay, 4 million divided by 1.4641. Okay, close the bracket. Plus, open another bracket. 12 million divided by 1.771561. Close the bracket. Equal. That's 10,
497
497. Then, so just
476.
press square root. Just press square root
Yes.
straight. That's 3239.98. So that's 3240.
So it's square root answer now.
Yes, that's 3240.
Oh, okay.
All right. I think the other one, I did not press the equal to, that's why I did not. Okay, let me just my pen. Let me
840.
so the final answer is 3240. So we're now asked to calculate coefficient of variation. Requirement number 4 now. I don't have space. I will just manage here. Requirement number 4. Coefficient of variation. CV. Therefore, CV will then be equal to standard deviation of NPV over expected net present value, which is equal to 3240 over 1793. This will give us 1.81. So that's it. That's end of the question. So majority of you have disappeared. No worries. I still have David behind me. Jeffrey is here. Ethan, IJ, Ijoma, Laura, Tosin, Sharafa, Usman, Ako and Co have disappeared. No worries. All right. Let me know if you have any question for me. This is where we are going to stop. In our next class, by the grace of God, we are going to be doing our sensitivity analysis. We will do a simulation and we also do decision tree. All right. So those are the three outstanding scope under risk and uncertainty before we move to business valuation. Okay. So let me know if you have any question for me. If not, that will be the end of today's class. Any question for me?
Are
All
these
right then.
examinable questions that they can bring it out like this?
What are you saying, Tosin?
I can give us like this. Like, can they bring it out like this?
This kind of question
Yes.
is what it is now. This is also a past question. Only that in recent time, I can don't test question on a complete question on standard deviation again, but the method that is common under risk and uncertainty is expected value as well as a sensitivity analysis. All right. Expected value is very common. Of all the methods of hedging risk and uncertainty, expected value method is the most common, then followed by sensitivity analysis. Oftentimes, in fact, in recent time, as a sub-requirement, examiner can ask you to calculate sensitivity margin of working capital. You can be asked to calculate sensitivity margin of selling price. You can be asked to calculate sensitivity margin of even tax liability. That was a particular question we solved under capital budgeting, whereby we were asked to, in the B or C part, in the C part of the question, you have to determine the sensitivity margin of tax liability. All right. So these are the these are the two methods that are common in recent time in ICANN exam. But whatever the case may be, is in your syllabus. You just have to know them. And no matter how big is the question, when you're asked to calculate standard deviation or expected value, is the same thing. All right. So that's that. So we are going to meet again next week by the grace of God. Then there is a public holiday coming on Friday, which is Good Friday, this coming Friday. So for those of you that normally have class on Sunday, we are going to the timetable for Sunday class will be used for Friday. Then on Monday, if I'm going to lecture you on Monday, I will let you know. All right. And then if I'm going to lecture you on Monday on SFM, that means it has to be a combined class. It has to be a combined class with the VI and then a solo student as well. So whatever the case may be, we'll get back to you. All right. Thank you, everyone, for your patience. I will see you next time by the grace of God. Good night, everyone. Okay.
Good night, sir.
Yeah, good night, bro.